Hi, Matt McAleer, Director of Equity Strategies, Cumberland Advisors, July 2nd. Already, July 2nd, end of the first half. Last week I mentioned I'd had some charts and some analytics to review with you. I got a little bit jammed up this week. I'll have those next Friday. Not charts just on returns and so forth. Those are easy to look up and find. What I want to try to do is present some different analytics that just make you think of what can possibly happen in different markets. Remember, charts don't tell us what's going to happen. It just speaks to possibilities. So we'll take a look at 2 or 3 or 4 next week. This past week, a little bit of panic in the market felt like, and a good panic if you position properly. There felt like there was a real panic into growth this week. We've been speaking about that really since about the 3rd week of May, how growth had gotten a bid versus value. Remember, you had that wonderful run in value from September of last year through March, even into April, with basic materials making new highs, banks making new highs, industrials making new highs. Then as we got through mid-May, you started to see tech and large cap growth dig in, relatively speaking, versus value. And it slowly started to produce better returns. Well, it's almost as if this week people realized they were out of position in terms of the portfolio and sold value to get into growth. In terms of our Cumberland portfolios, we're barbelled, as I've mentioned. We have growth and value. We're overweight growth right now, but we do have value. Where could we get in trouble with our value positions? Well, we could probably get in trouble if we get no help from the interest rate market. Financials, banks are really dependent on some higher rates here. Not skyrocketing rates, but enough rates to drive some margin in their spreads. They borrow at X, being close to 0, and lend at the prevailing rate out there. As rates come down, spreads narrow. Now there's much more into a bank's business than just spreads, but the market looks at spreads. Remember, perception is reality in this business. So the perceived thought that rates have already peaked this year is putting some pressure on banks and financials. Very interesting, fascinating. The market is a 3D puzzle. If we had gone back to March when the 10-year Treasury was trading at 172, 173, and polled money managers, fixed income money managers, about whether they'd see 140, 142 first or 2% first, I think you'd have 80% looking at 2%. May have some scenarios where people are out of position there. You're seeing a bid each time rates back up. Rates back up, demand comes in, pushes rates back down. So in terms of some different changes we made in the portfolios or adjustments, US ETF. Early this week we added some QQQ to our core portfolio just to get a little growth here. Midweek we added semiconductors to our US ETF portfolio. Again, we had some cash, as we mentioned. We were up around 10, 11, 12% cash. We've taken that down to 7% cash. Got a little growth here. Tactical trend. We have a fund position we added late last week, and we may add a little more to this. We wanted to get in to something that may have legs 12, 24, 36 months out in terms of a growth plan, and that was Airbnb. Now, we don't just buy in tactical trend a fundamental story. The technical story has to match up, and that's what happened. We got higher lows through the 140s, broke 150, traded into the upper 150s, and have now pulled back. 148, 149, 150, 151, nice place to add here. It's only a small 2 or 3% position. We'll see if we can build that. Reminds me of some of the stories back, 96, 97, 98. the Amazon stories where everyone thought you were crazy. It's overpriced. It'll never make money. It's losing money. I'm not comparing Airbnb to Amazon. But what I am mentioning is sometimes you have to look through the actual expense on a price to sales type of scenario and look at a business model, look at how the stock's trading, and look at some of the revenue growth rates. So we'll see where that position takes us. International, we got rid of a position that's been irritating us for a few months. That was Indonesia. It was our smallest position in the portfolio. Couldn't get its legs under it. It would trade up, trade down, showed no real trending ability. We did sell that position and added Sweden, EWD, give us a little bit more Europe, give us a little bit more of that economy that is really starting to perform right in the face of COVID. So, interesting week here. We had a number of different trades going on. We'll take a look next week. If we do look at that Q trade, the Qs trade, which was a runaway train this week, it is running into an area when we get to that 80, 85, 90% overbought on a weekly stochastic where we may get a little pullback. So we'll have to see. Microsoft and the rest of the big Q names, Apple, Google, Amazon, really pulling that train over the last couple of weeks. Have a great 4th. We'll see you next week.
Hi, it's John Mousseau, President and CEO of Cumberland Advisors. It is Friday afternoon on July 2nd. Very more or less quiet week in the bond market this week, and we expect a quiet week next week with a holiday shortened week. You saw long Treasury bond yields down about 10 basis points or so. Long bond down from 215 to 205. 10-year bond down from about 155 to 145. Muni yields down half that much, but down. And what did we see this week? We didn't see evidence that yields should be dropping. It was more like posturing for quarter end, of course, and people positioning and the like, because the evidence is that the economy continues to grow and do well. We saw initial jobless claims less than expected this week, down with a 300,000 number. That's a good sign. We saw non-farm payrolls increase up to roughly in the 800 plus category when you were expecting about 720. That's a good sign. So the evidence would suggest that yields will eventually move higher down the road. As we talked about last week, right now there's a disparity between where inflation is, running about 3.8 or so on the CPI on a yearly basis, versus where, say, 10-year bond yields are at below 1.5%. As we pointed out also last week, you can have some longer periods of time when yields stay below what inflation levels are. Eventually, things kind of come back together. So probably inflation moderates a little bit and probably 10-year bond yields start to climb a little higher, particularly as you get further out in the year and the Fed gets closer to changing their stance a little bit, perhaps raising short-term interest rates next year as opposed to the year after that, and starting to reduce some of the monetary accommodations out there in the purchases of treasuries and agencies. So that's all to come. We will know more, of course, as we roll on into later this month. And again, we'll have initial jobless claims next week, a pretty small week for economic indicators. And then, of course, as you move out further in July, we'll get June CPI and PPI and other measures that'll really tell us what direction we're going in. So we hope everyone has a really good weekend, a safe weekend, and we'll see you next week. Thanks a lot.